Everybody's watching oil right now, and almost nobody is watching the signal that matters the most. In fact, this just hit an 11-year extreme, and if it stays broken, inflation will stay sticky. More importantly, we're going to see prices rise, and stocks, well, they simply get complacent, and this means bad news for every investor. There is, however, one market signal that's flashing right now that's telling us this is not normal. In fact, it's telling us something is wrong. Brent crude has surged over $112, with the WTI lagging underneath. It isn't just about the gap. This is the gap between two that just hit the widest level in 11 years. And that matters because, well, this market is telling you that inflation shock is global. It's not local. And if that is true, well, the whole rate cuts later this year idea gets a load weaker. What's going on, everybody? My name is Mike. I've been investing in the risk markets now for the last 10 years. And this is not financial advice. And I'm definitely not a financial advisor. I just want to talk about the markets, and I want to get your thoughts on it because right now, this is the most important topic that, well, no one else seemingly is covering. So most people hear that oil is up and, well, they stop there. But the better question is, which is oil up more and why? Brent is the international benchmark. WTI is kind of the US benchmark. And ultimately, they give us an idea of global pricing. But when Brent massively outperforms WTI, it usually means that the markets are pricing in seaborne supply risks, global transport stress, and tighter barrels for the rest of the world. Now, this aligns to the fact that the Straits of Hormuz has been closed, and the Iranian government are now saying that they are simply not going to open. But if you've got $2 million, then they may offer you safe passage. Reuters reported saying that exactly what is happening now in the Middle East conflict escalates to the Straits of Hormuz disruption, and it keeps hitting global flows. Now, this is definitely not helped by the fact that Donald Trump just escalated the whole war in Iran to new levels and could actually see even further infrastructure in oil and gas take another big hit. But here's a simple version if you understand. For the world thinks the Gulf is becoming harder to move oil through, well, Brent gets even harder because Brent is the barrel most directly connected to global waterborne pricing. WTI can stay relatively less hot because, well, the US has domestic supply. This was where the whole idea of Venezuela comes in, and the fact that they're basically going to refine this now in Texas and other states. Now, this is important though, because domestic supply inventory dynamics and export flexibility, that cushioning, that essentially now can support the move. Reuters reported that Brent WTI discount widened to the biggest gap in 11 years, helped by US inventory builds and crushing strategic petroleum reserves releasing. Well, while Brent just essentially got a war premium, and now that everybody on the global market is desperate for oil, it is showing no signs of going anywhere else. But this is where it becomes a real macro story. The wider Brent premium means the more important inflation pressures for energy consuming regions, and the more pressure essentially is put on shipping, fuel, import costs, and globally, this is a massive risk. Now, we're already starting to see this. Central banks reacted to the fact that this risk is here by holding their rates. 3.5 to 3.75% was what the Federal Reserve did on March 18th and said inflation remains somewhat elevated. Now, the ECB raised its 2026 inflation projections to 2.6% because of energy prices. And finally, the Bank of England also held at 3.75%, but warned that a long, drawn-out conflict actually could therefore keep prices higher and mean that inflation will certainly not be coming down anytime soon. So this isn't about oil traders. This is actually about the bond market and the equity markets right now repricing based on the central banks and the global oil shortage. In fact, the AP reported that as oil jumped, the 10-year Treasury yield climbed to 4.38% and hopes of Fed cuts were fading. Stocks sold off hard on the back of this into Friday, with the S&P 500 down about 1.5%, with the Dow off 443 points. Well, and the Nasdaq, I'm sure you've seen it, took another dump of 2%. That's a chain reaction. Oil up, inflation fears up, yield up, multiplies down. It creates concern in the market and it doesn't show signs of getting any better. The danger here is that it's not only high oil, it's high oil with a broken spread. And if Brent stays this elevated relative to the WTI, the market is telling us that global supply stress is not solved yet. Now remember, mainstream media, as well as Donald Trump, wants you to believe that everything is okay, and actually the Straits of Hormuz is going to be open and running. The problem here is these have now hit Brent record levels since July 2022, and Monday indicators are now showing that this is still going to be high. It means that every bullish central bank review simply now needs to change, and the argument to compete with a totally fresh energy shock is coming sooner than ever. But what does it mean to the stock market? Well, this is where people can get blindsided. If only you watch, let's say, headline news, index prices, then you can miss what is happening underneath. The AP once again showed that the Russell 2000 was hit even harder, showing risk markets are taking the big bear of the brunt, and actually that large cap benchmarks on Friday certainly weren't any better. Other market breadth coverage has shown participation weakening, and actually under the surface, small caps as well as cyclicals and rate sensitive names tend to feel this first. They cannot hide behind giant balance sheets, huge capital, and mega cash flow. And more importantly here is that it also explains why this story is bigger than the US. In the UK, for example, Reuters report the 10-year gilt yields moved above 5%. That's the first time in history we've seen these in a non-wartime effort. And Europe, well, the ECB allegedly acknowledged higher energy prices are lifting inflation. All of this is bad news, while at the same time, mainstream media are pushing the narrative that everything is going to be fine. The fact here, prices and projections are weighing on growth. So it's not just one country right now that's got a problem. This is a cross-asset, cross-border repricing event. Going forward, what are the things we need to keep your eyes peeled on? Well, first, does Brent stay above roughly $110? This could be a signal. Also, second, does Brent WTI spread stay historically wide? Remember, 11-year high. Normalizing. Third, the yields keep rising, and this could be on weak equity days. And if yields do keep climbing, by the way, stocks fall, then the market is essentially saying that there is inflation risks and they are still overpowering growth fear, and that is a much tougher backdrop for risk assets. Currently, reporting suggests that exactly the tension going on in the Middle East, investors are dealing with real panic, and actually sell-offs are probably going to continue this week, with the bond market, equity market, and the crypto market repricing a negative view. So where does this all put together? And by the way, drop your thoughts in the comments straight away. The big takeaway here is the most important move right now may not be oil just in itself. It's actually the Brent versus WTI metric. If Brent is far higher than WTI, it is telling us that the market is pricing global supply stress, not just temporary headline spikes. And if that pricing right, then inflation stays hotter, well, this can push further out. And equities still have fully adjusted. This is why an 11-year spread blowout matters so much. Now, if you want to stay ahead of the market and get an edge on every other investor out there, hit that subscribe button and grab some longer content over on my crypto channel. I'm going to leave the video there. Click on that, go and take a look at it. But as always, thanks for watching, and I'll see you in the next one. Bye-bye.